Stocks gaining today on optimism the Fed may be done raising rates. Treasury yields sliding on the news, but JPMorgan Chase CEO Jamie Dimon doesn't necessarily agree with that call. Yahoo Finance executive editor Brian Sozzi spoke with Dimon last night.
I think they did the right thing to raise rates rapidly, and I think they're kind of right to pause here a little bit and see what happens. But I suspect that they may not be done. I think there's a chance that inflation is just a little stickier than people think.
For more market reaction, we turn now to Nancy Daoud, Ameriprise Financial Private Wealth Advisor. So, Nancy, let me get your take on this. I mean, you saw the Fed's statement yesterday. I'm sure you listened to Jerome Powell's presser. Some investors perhaps deciding today, hey, the rate hiking campaign is over. But meanwhile, we just heard from JPMorgan's Jamie Dimon. He's not so sure. What do you think?
Yeah, I don't disagree with him. I think that all the hype and the optimism is wonderful, and it's great that the market is up. They're even talking about this being a Santa Claus rally. I don't think so. We're a little bit early for all of that. And I do believe that we may see at least one more rate hike. But it will really all be very data dependent, just as Mr. Powell indicated.
Nancy, what would justify another rate hike as you see it? I mean, the argument sort of going into the decision yesterday was that the market, specifically the bond market, has been doing a lot of the heavy lifting for the Fed. So with rates where they are, even though we've seen a pullback today, why another hike?
Well, it all depends on the data. I mean, the jobs data will certainly be very important. The strength of the economy is beginning to show some signs of weakness, even in corporate earnings. But the jobs data report will be very important. It really has to do with what the data shows in the next few weeks, that whether we will have another rate hike or not this year in November. But I wouldn't bet on no more rate hikes. I think there may very well be another one for the year. And certainly no rate cuts anytime soon, which a lot of people have been talking about.
Nancy, let's turn to the equity market. I'm just interested, as we sit here now, we're in November. Do you think we are in for a year-end rally? Are you in that camp? I know others, Morgan Stanley's Mike Wilson isn't expecting that, says chances of fourth quarter rally have fallen considerably in his opinion. What do you think?
Well, I think we're probably going to see a boost. November, December those are the months where we see the year-end big hike in the stock market. And then I would expect that would happen. Although there's a lot of rumors that retailers are not indicating as such, I don't believe so. I still think that there's a lot of cash out there. And it really all depends on where you are in the food chain. If your income far exceeds your outflow, then the effects of the inflation haven't hurt you as badly. Whereas if you have even cash flow or negative cash flow in your household, the effects of inflation are definitely showing up at this point. But in general, I do believe that we will see a good boost in the market November, December.
So how are you advising clients right now in terms of how they should be putting that cash to use with the expectation that there could be more upside in the next few months?
Well, we've been on the forefront on this. So during September and October, when everybody was fearful and investor sentiment was going downhill, that was the opportunity. Those were the opportunity months. And that's when we deployed new cash, but certainly with a little bit of caution because we're still not out of the woods with the fighting inflation. And then also the new wild card here is the war in Israel and how that will affect us. And that certainly has affected two things, energy prices and consumer staples. So those are sectors to look at and have been the two sectors that have been up significantly since October 7th when the war started. So there are always current events that affect some of our thinking, but if you were in the forefront in this and were entering the market in September, October, you're feeling pretty good right now, even though we're probably in for some more volatility, but it should have been a good move.
And in terms of sectors, Nancy, I see here you also like utilities. How come? What's the thesis there?
Well, we're still very defensive, so we look for value stocks, utilities, financials, and the healthcare sector have been very steady. and in giving us the income that we need in order to offset the volatility. And then as far as opportunity, we always look for what has taken the biggest hit. So I see opportunity in small cap stocks because they're down significantly, have not performed as well as large cap, but with a great deal of caution and risk appetite check. And also bonds, fixed income got its name back. We actually have income in fixed income again. And so if indeed the Fed will stop raising rates and actually cut rates later in the year or next year, then you'd be very well positioned in the bond market if you start to begin to enter now.
So in terms of sectors going after those that have been underperforming, what about some of those higher growth names? We've been talking so much about tech and AI. Are you taking some money off the table in that area?
No, I think we're holding steady because although there's a lot of volatility, ultimately these companies will do well. And it's really like anything else. If the company has a good balance sheet, good cash supply, they will weather all of the storms that are coming up. However, if they're highly leveraged or in fact have loans coming due that they have to refinance at a much higher rate, then there will be some gyrations or consequences to that. So the key to all of this is selectivity. You've got to be selective about which companies you're getting into as opposed to just across the board in the tech sector.